This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
5 out of 5 for the Jason Hartman podcast. Thanks to his teachings, I have no worries about my future. My future is bright, and that for my family. I recommend the Jason Hartman team to anybody who is interested in financial freedom by way of real estate investing. 5 out of 5.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1795, and today we are going to attempt to answer the question, what is money? With the very well-known speaker on that topic, and that is Robert Breedlove. He is an expert in money and cryptocurrencies and BitCoin, and I think you'll find this discussion to be very interesting. But first, have you registered and are you joining us for our virtual event coming up on Friday and Saturday? That is a virtual Creating Wealth event. This is my oldest educational program. I've been teaching this for about 18 years now, and it has been very well attended and very well loved. As we talk about this question of what is money, we will talk about that, and we will take Q&A, we will have investor networking, and we will go over a lot of my core topics, the Hartman Risk Evaluator, a deeper dive into inflation-induced debt destruction, my predictions for the coming year, and some detail on that from what you may have heard on the podcast just last week. So I think it'll be very interesting for you, and it is very easy and very, very inexpensive. So register for that right on the front page of jasonhartman.com, the big red banner at the top, and join us this Friday evening and on Saturday for a few hours as we go over the Creating Wealth in Today's Economy content. I think you'll really enjoy that. So register at jasonhartman.com. Also, if you are interested in the collective, we have got our second event coming up in Naples, Florida, and that is the first weekend of February. And then we've got our event after that in Dallas and then in Mexico. So be sure to check that out or reach out to me or any of our investment counselors about the collective as well. And be sure to also join us for our virtual event this weekend. We will look forward to seeing you this weekend for our virtual event. But for today's episode, let's talk about what is money with Robert Breedlove. It is my pleasure to welcome Robert Breedlove to the show. He is the host of the What is Money show, and he is a big expert on the topic of money and understanding what money is, what it is not. And of course, that dovetails into the cryptocurrency subject in a big way. I think you're going to find this interview to be fascinating. Robert, welcome. How are you?
I'm great, Jason. Thanks for having me.
Good to have you. And you are in beautiful Hawaii, right?
I am. I'm on the beautiful island of Kauai.
Yeah, good stuff. In paradise.
Yeah, it's not bad here. It's a good place to be amid all the madness in the world.
Yes, absolutely. You're kind of away from it all, so that's good. I think it would be a good place to start with you to just talk a little bit about the history of money. You've gone so deep on these topics, and they're just really, really fascinating, I think, for people to understand how money developed, what it really is. A lot of people don't have their head around what money really is, do they?
Well, I think there's a good reason for that. The namesake of the show is the What is Money show. And I have a document, because I also do a lot of writing, that has over 50, that's 50 answers to that question. So it's not simple, like it's not straightforward.
Yeah.
So I actually always kind of struggle to decide which answer to go with here. But I think the first most important thing is that we have this modern misconception that money is somehow the domain or exclusive enterprise of government, that perhaps government even originated money. It's somehow part and parcel to the affairs of human governance. And that's simply not the case. To look at how money emerged, when we shifted from hunters and gatherers to becoming an agricultural society, right? We settled down in single areas and decided to cultivate the land. There's some dispute as to the reason. The common conventional wisdom is, hey, we wanted to produce more food, per unit of human energy expended. But it looks like we may have actually done it to get drunk, actually, that people enjoyed fermenting grains and whatnot. So it was to make beer and ales and things like that. So maybe it's a little bit of both.
Yeah. Well, there's definitely a whole school of people, as you know, who think that agriculture was actually the beginning of the downfall of human health, because we started eating the grains and so forth. Yeah.
Yeah. So the average hunter and gatherer actually had although they had a shorter, actually, I'm not sure about life expectancy, but they were much less prone to disease and they had much greater digestive health. Mm-hmm. They were much more physically active. So they had a higher quality of life, actually, than people in the agricultural age. But when we settled down to start cultivating the land and producing, more crops or more food energy per unit of human energy expended, we started creating the first economic surpluses in the world, right? We actually had savings for the first time. And a lot of this savings was in the form of food. And so this created an interesting dilemma for humans, in that all of a sudden we had this residual economic energy, if you will, this economic surplus that was being produced. It had to be stored, but it also had to be safeguarded, right? We had to protect this economic surplus, this food energy, from plundering from other tribes or groups that may want to attack it and steal it for themselves. This was the origin point of government. Government is the local protection enterprise for the economic network, right? In this case, it was just small agricultural enclaves, and they needed physical protection from potential predation from without.
Right.
So this starts to kind of bootstrap economies in a way, right? You have these different farming communities, and then, eventually they figure out, hey, we can specialize in corn or certain fruits and vegetables. Another community that may be in a different climate or a different topography can specialize in something different. We can trade with one another, and we achieve the division of labor. We get, more quality and variety in our diets. And it's not just food, right? It goes on into farm agricultural tools,
Right.
As governments are establishing their protection enterprises. This is weaponry. All of this, we discover basically the core principle of economics, which is we are more wealthy operating in concert than we are in isolation, right? And this is the reason we even have society. If this were not true, we wouldn't care to band together. There'd be no efficiency gain.
Yep.
So
the specialization of labor is what really made that difference.
Exactly, 100%. And to get to the answer to the question, what is money? Once this starts happening and humans figure out, hey, trade, and this isn't like some intellectual discovery, this is just a tacit lesson of I can eat more food by cooperating with this group through trade. As these networks start to wire themselves together into trade networks, whatever becomes the most liquid asset in that community, or the most tradable asset, is money. That's it. It emerges naturally in any trading society. So you can think of money, like one answer for it would just be the epitome of trade in a way, or the most liquid good. And then it just so happens we have this long history of the government seeking to commandeer and control that most liquid asset and there's a number of reasons here, but they would certify the validity of money, right? The original coinage was basically a certification function saying, I, the king, or I, the guy with the biggest stick, certify that this coin has 1 ounce of gold or whatever the content is. So instead of needing to weigh that coin at each transaction and verify and say its value, I could just trust the reputation of the authority. And this would economize trade, because now we could just, oh, the coin looks good to go. I don't need to stop, weigh it, measure it, and all of these things. So that's,
but then
one
people
definition
started
of
clipping the edges of those coins.
that's right. Typically, the authorities themselves clip the edges of those coins.
Well, that's normal, right? That's just like today.
That's inflation. That's ancient inflation.
Absolutely. Okay, so the what is money topic, yes, 50 answers to that question, but that's a good primer. So money created the specialization of labor, or it was an outgrowth of the specialization of labor, because barter was bulky and cumbersome and didn't work very well. And so a lot of advancement came from this. But then we got to kind of where we are today, fast forward a couple, millennia, right? And where are we today? Of course, everybody is learning the ugly way about inflation right now. Certainly, I think this is probably much worse than the 70s already, because it's much more manipulated nowadays than it was back then. And the central bankers have all changed and learned a lot more of how to lie to everybody.
Exactly.
But where do we go from here? Like, maybe where are we? Where do we go from here? And then let's talk about your ideas with cryptocurrency and Bitcoin specifically, maybe.
Yeah, so we established that money is an emergent phenomenon, right? It's just like markets discover prices, markets also discover useful tools. This is what we call innovation, right? People are competing in the marketplace, trying to satisfy the wants of one another, better, faster, cheaper. And from that process emerges the best tool for the job, right? But we keep discovering newer and better tools so long as we keep trading and innovating. This is just like you mentioned, the specialization of labor. The internal reflection of that is the specialization of knowledge, right? Once we figure out how to produce the best tool for the job, then we, as an entrepreneur, we have an incentive to trade that into the marketplace. The marketplace becomes suffused with that information, and everyone starts using that tool, right? That's why we're all on smartphones today and laptops and driving cars and flying planes. These are the best tools for the job, basically. So in the sphere of money, over this 5,000-year history of humans trying different things as money, right? And we've tried a lot of different things: seashells, salt, cattle, women, like we've tried a lot of things. Gold emerged as the most functional monetary technology, like full stop.
Yep.
We know that. We all know gold's valuable. The modern day, we don't think deeply about it. We sort of consider it to be this crisis insurance for a portfolio, but it's something much more fundamental than that. The problem, and I've talked about this a lot, so I won't labor the point, but there's basically properties of money that people seek. And I narrow it to 5. There's divisibility, durability, recognizability, portability, scarcity. So gold is the best tool for the job, the best one at satisfying those desired functions of money. However, it was limited in terms of its portability. Gold is heavy, gold is physical, gold is expensive to secure, it's expensive to transport. It doesn't accommodate a high velocity of money for a globalizing society.
So one of the things you said there is interesting, and I just want to bring this point out. The weight to value ratio is important when considering money.
Yes.
And that's why so many of the ultra rich invest in art, because it has a very high value density.
Yes.
And it's fairly portable. Now, granted, you can't put it in your pocket like an ounce of gold, but it's got, maybe it's worth $100 million for a painting, right?
Yes.
And so that's one thing people look for. And it's really interesting to think of that when you think of cryptocurrencies, because they don't have any density. Well, maybe some electrons, right? But
well, they don't have any weight. So in theory, the value to weight ratio goes to infinity.
Actually, that's a good way to look at it. Yeah.
Which is a very interesting point. An excellent point, actually. Gold, that's a good way to think about it. It was the tool most capable of storing economic density across time, right? Or value density. But again, the problem with gold is that it's not fast enough, essentially. Hard to beam around the world and facilitate transactions in gold because of its physicality. So what do? We're humans, right? We use our ingenuity. We figure out a way to augment gold to make it scale and support a globalizing society. And we do this via the centralized custodian,
Right.
which was a warehouse originally, became a bank, and today we call it the central bank, right?
Yep.
They hold the gold. They facilitate these interbank ledger entries, which are just saying, take debit column A, credit column B, and we all reconcile our transactions. But we don't settle in gold. We don't settle with finality very often, right? And it got to the point where by 1971, right, the world's been fighting over gold for a long time. Post World War II, the United States rewrites the international banking order to suit its own interests.
Yep.
We peg the dollar to gold. Everything else is pegged to the US dollar. This gives the US the infamous exorbitant privilege to just produce money, send it out into the world, receive goods and services in exchange. The system works so long as other nations had the call option on the US dollar. They could convert US dollar to gold. Well, they did this for some 30 odd years.
Yep.
Before finally, of course, we had the incentive to produce excess dollars, which we did. I think it was when Germany tried to repatriate their gold near 1970 timeframe that Nixon engaged the infamous Nixon shock, closing the gold window, putting the entire world onto this global fiat currency standard. And I always encourage people at this point to check out the website WTFhappened1971.com.
I love that website, by the way.
Yes.
There is every chart and graph you ever wanted to see is on WTF 1971. It's great. Yeah.
Yes. And it's way more than a financial malaise since 1970, right? This is socioeconomic, right? Addictions are up, suicides are up, debt is clearly up, divorce rates, political divisiveness. So it just points to how the corruption of money percolates through the entire sphere of humanity, and it's poisonous. So we have this saying in Bitcoin, fix the money, fix the world.
Right.
And I think, the more I've studied, the more weight I think that simple phrase carries.
Robert, I want you to tie that in for our listeners and viewers a little bit, because after reading the Bitcoin Standard and then having Saifedean Ammous on the show, I never really thought about it the way he said it. I mean, I knew what he said wasn't new to me, the idea of time preference and how that affects the culture, but he just went deeper and caused me to go deeper in my own mind about it. Is it fair to really attribute all of these societal ills, the ills were out there before, but they've increased, right? No one would deny that they've multiplied. Or maybe it's just that we're counting things better now or paying attention to it more, or there's more media in the culture, obviously. How can you attribute all that stuff to the money, right? The debasement of the currency and how that accelerated massively after August 15th of 1971 with Nixon's famous speech about how he was going to temporarily suspend the convertibility.
Yeah.
50 years later, here we are.
There's nothing more permanent than a temporary government solution, right?
Yeah, Milton Friedman.
I don't want to say it's a univariate cause. It's not like breaking the money caused all of this. All this, even as it relates to time preference.
Yeah.
There's a multivariate analysis of time preference, right? Like you tend to be a little bit higher time preference, which this gets a little counterintuitive. Lower time preference is better. Lower time preference means you have a longer time horizon.
Right.
You tend to have higher time preference when you're younger, right? In your 20s, you're just spending, having a good time.
Yeah.
Then in your 30s and 40s, you hit kind of your peak earning years. You maybe start a family. You're engaged in longer term relationships. You've seen the world a bit. You've probably been in some trouble of some kind in your 20s. I don't know. You've learned, right? So your time horizon tends to expand a little bit, especially if you've had kids. I think that's a big one, right? Just having kids lowers your time preference a lot because all of a sudden you're thinking about their life. You're experiencing life beyond yourself in a very meaningful way. And then when you get...
But can you just come back to that in a minute? I want to make sure people understand what time preference is. And this is the idea, it relates to time value of money and inflation. And the idea that which Saifedean points out, that people are literally making decisions, maybe subconsciously all the time, because they know that the money is just losing value.
Yes.
So tell us about what time preference is, and then just hold that other thought, go back to that, because that was interesting.
Yeah. So to define time preference, it is simply the ratio at which you prefer the future to the present.
Right.
And it's quantified by the natural interest rate. I want to really emphasize natural, because the interest rate we see reported by central banks is not natural. That's
obviously, especially
centrally
now.
planned economy.
Yeah.
You could think of it like this: the higher the natural interest rate, the more interested I am in receiving capital now versus later, right? So I have a higher time preference effectively. I'm less likely to save when the interest rate is higher. And this means in particular.
Well, you mean the borrowing rate or the savings rate? You mean the borrowing rate in that?
But here's the thing. This is where it gets complicated. We always think interest rates, like what is my bank account bearing? But this isn't even specific to money. This is capital more broadly.
Mm-hmm.
So the ratio at which you prefer receiving capital now versus receiving capital later. So if the interest rate is lower.
If the interest rate is lower, then you're going to want to borrow money and maybe spend the future, right? By going into more debt. And if the interest rate is higher, you're going to want to accumulate capital because the capital's working for you. Is that a fair way to look at it?
Time preference is just that rate, the rate at which you prefer the present to the future. So the more short-term oriented you are, the more likely you are to consume, the less likely you are to save, the less likely you are to be concerned about the future at all. So when money, and this is again just one factor influencing time preference, is when money is being debased, you can't store value in money.
Right.
When you can't store value in money, then you naturally are disincentivized from worrying about the future. Right? You're incentivized to spend that money, to consume. And you could argue, and this is part of the Keynesian argument, that you're incentivized to invest. The problem, of course, is when money's being debased, is you're literally just trying to get out of cash into anything else. So this causes a misallocation of capital, right? This distorts price signals. This induces entrepreneurial overborrowing. And there's a long, history on this, on basically the Austrian business cycle theory.
Right.
Where these falsified price signals propagate through the economy. They mislead entrepreneurial action, where you're going to take on certain projects that appear to be profitable at the outset, but once inflation kind of percolates through the economy, you realize that it's not. And then you end up with all these busted projects effectively.
Yeah.
And when you have systemic bust, that is a recession.
And we'll be back with a lot more on this topic with this guest on our next episode.
Hi, everyone. Do you ever wonder why mass inflation is still a threat to rich countries? Some countries are privileged to have stable currencies. As the reserve currency of the world, the US dollar has enjoyed an enviable position that most countries would die to have. Except for the 1970s stagflation scare, the US has cruised along without many inflationary hiccups in its recent history. Some countries haven't been so lucky. At one point, Venezuela was one of Latin America's wealthiest countries. In fact, its wealth was so impressive that by the 1950s, it became a magnet for migration from countries like Italy, Portugal, and Spain. Oil was its primary export, but it had a growing steel and mining industry as well. Its currency, the Bolivar, was one of the strongest currencies in Latin America. In this regard, Venezuela was indeed exceptional, because Latin American currencies tended to be very volatile. However, in the 1970s, Venezuela's economic model began to change. In the middle of that decade, its oil industry was nationalized. From there, the Venezuelan state began to embark on massive spending ventures and relied on high oil prices to finance such largesse. But when oil prices plummeted, economic reality set in. Government programs do not come cheap. Eventually, someone must pay the bill. In 1983, the Bolivar underwent its most significant devaluation to date, ending a relatively unblemished track record for the nation's currency. Although many believed that this was a temporary setback, things never went back to normal in Venezuela. Towards the end of the 1980s and the early 1990s, the country attempted a series of market-based reforms with limited degrees of success. That said, the government could never contain the inflation beast. In 1989, inflation stood at 84%. Poverty was growing, and the Venezuelan populace was growing restless. Eventually, they took to the streets, with some protesters resorting to acts of violence. The government response was rather brutal, leaving hundreds of people dead. Known as the Caracazo in 1989, this crackdown was a major turning point in modern Venezuelan history. Venezuela's otherwise robust democracy started to be called into question. To make matters worse, a rising lieutenant colonel by the name of Hugo Chavez launched 2 failed coup attempts against the government in 1992. Although Chavez was imprisoned for his actions, the damage was already done. On top of that, none of the country's structural economic problems, such as inflation, were ever really addressed. Inflation reached near triple digits, 100% in 1996, and continued eating away at everyday Venezuelan savings. By 1998, when Chavez threw his hat in the country's presidential race, Venezuelans were completely infuriated at the political system and pulled the lever for the former lieutenant colonel, who marketed himself as the anti-system candidate at the time. Unfortunately, Chavez's rule did not fundamentally address Venezuela's economic problem. In fact, his administration arguably made the situation worse, especially with regards to inflation. This goes to show that there is strong institutional inertia in politics, and even when so-called reformers come onto the scene, they're unable to roll back the policies their predecessors put in motion. Chavez's successor, Nicolás Maduro, has also failed to tame the country's inflation scourge. According to recent figures from the statistics website Statista, Venezuela's current inflation rate is hovering around 2,300% to 6,000%, which is considered hyperinflationary. From a big picture view, inflation has been a hallmark of the Venezuelan economy for the past few decades. Here's some perspective. The last time inflation was below double digits was in 1983. In effect, the average Venezuelan millennial has never witnessed a year with inflation below 10%. Here's the thing about economic upheavals. They can wreck even the best of nations. And they usually can't be controlled regardless of who is in charge. There's a lesson here, and Jason has taught you this many times. You can't control the political or economic elements, but you can take advantage of crises and benefit from them. While I doubt that inflation will reach Venezuelan heights, you should always remain vigilant about the U.S.'s economic climate. Currently, there are debates about whether the U.S.'s inflationary spell will be transitory or more durable. Jason tends to believe in the latter. Nevertheless, you should never lose your cool and think the whole world is doomed. To the contrary, inflationary moments provide a host of new opportunities for real estate investors to thrive in. And they can do so by using Jason's favorite 4-letter word, debt. In this case, he's referring to mortgage, not consumer debt. Consumer debt is a big no-no in his book. But taking on a mortgage is a different story. You see, this kind of debt is an asset when inflation hits. First, you acquire an income property. Then you rent it out to a tenant. In doing so, the tenant picks up the carrying cost of the mortgage. Meanwhile, the mortgage's real value depreciates due to inflation. This infuriates the banks but creates a great opportunity for you. So learn from Jason and take advantage of his inflation-induced debt destruction strategy. It's a great time to be alive. For more information, visit jasonhartman.com.
So George Gammon, Jason Hartman, and I, we've created a high-level mastermind group called The Collective. The goal of The Collective is for you to learn from the three of us, as well as, of course, the other members, on how to build and, more importantly, how to maintain your wealth. In this video, we're going to go into detail about what The Collective is and what it can do for you. Enjoy. So I'm Ken McElroy. I've been in real estate for over 30 years. Started with a 2-bedroom, 2-bath using my own money. And now I own over $1 billion worth of real estate that I bought over the years, built a big company. We have a construction company, a development company, a property management company, and of course an investment company. And typically now we syndicate and work with large, both private and public institutions for the equity and the debt. And so what I bring to the collective is how to scale, how to grow, starting with one really small property with no experience at all and growing it into an organization, which I've been able to do that basically runs almost without me. So that's what I'm going to bring to the collective. We decided to start the collective because, one, I met George Gammon, and George brings a very interesting perspective about the economy and the Fed and the way money works and Bitcoin and alternative types of investments, which quite honestly, I was super focused on real estate almost the entire time. And even I want to be a little bit more diverse. So when I talk to George and to Jason, they're always doing very, very different things on the investment side. Jason specifically is more focused on the single family housing and what's going on in that market so that we could collaborate and have different viewpoints on different things. And so that's why I thought the collective would be good, because I think everybody's kind of searching for the same kinds of answers. So the collective means to me, basically, the collective group, the whole. And I've always been a big believer of team and collaboration. So for me, it really means collaboration, of everyone kind of coming into a room and learning from each other based on their individual highs and their individual lows, and to be very, very respectful of all their independent views on things, and to be more open-minded, transparent, and authentic. So I cannot wait for the group to get together each and every quarter, because we all have very different walks of life that we're going through. And so it's very, very cool to get into one room with like-minded people. I think the right person for the collective is somebody who's into personal development, somebody who's trying to be a better individual, somebody who's trying to have that work-life balance, trying to figure out good decision-making on the investment side specifically, good decision-making on the personal side perhaps, certainly on their health and on their wealth. The members that have already signed up are people typically that have businesses that they're growing, businesses that they've started, or businesses that they've sold. So typically they're higher net worth and they're trying to figure out what to do with their money. They're probably a little bit afraid of inflation. They're probably a little bit concerned about where to invest. And they're obviously looking at real estate as one component, somebody that's trying to do the right things both on the personal side and on the financial side. So some of the experiences that members can expect to get out of the collective are certainly the network. And I think that's always super powerful. I've been involved in groups like this before, like EO and YPO, the Entrepreneurs Organization, and YPO, which is Young Presidents Organization, which is kind of a peer-to-peer network. And that's what I envisioned, and I think people are gonna certainly get that out of there. They're gonna have lifelong friends for sure from this, and they're gonna meet people at every single event. But also, we're gonna have fun. So as an example, things like race car driving and doing all kinds of really cool things and meeting celebrities and things like that, and fashion shows are gonna be part of it. So it's kind of a, how do we have fun and learn together? And we're gonna have that at each and every event. So thanks for watching. If you guys are interested, there's a link below you can click on. It'll take you right to the website, which has a load of information on exactly what the collective is, where the next events are, and what exactly you'll be getting if you become a member. Thanks for watching.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.